December 29th, Monday morning. Silver dropped from $83 to $74 in just 30 minutes, which is a 12% crash. You need to understand what really happened here, because this wasn't just a crash. This was one of the most calculated moves I've seen in the silver market in years. And if you don't get what's going on, you're either going to panic at exactly the wrong time, or you're going to miss what could be the biggest silver move we see in the next decade. I spent the last few hours digging into this, looking at the data, and what I found is actually wild. So let me walk you through exactly what happened, who profited while retail traders got destroyed, and why this crash might actually set up silver for a massive run to $100 or even $150. But first, if you find this valuable, just hit the like button and subscribe. I put a lot of work into researching this stuff. Alright, let's break this down. So silver's been on fire lately. I'm talking crazy gains. It went from like $40 to $83 this year. That's basically doubled. And everyone's getting excited, right? Now $83 was a strong resistance level, and then we saw a sharp correction to the downside. But it has never been there before, which is a historic moment. And here's where it gets interesting. Silver had gone up about 18% over the last 2 trading days. After that, it crashed 12%. And what we saw on Monday was a sharp correction, not random selling. On Monday morning, a large sell order entered the market. This was not retail activity. The speed and size of the move point to institutional and algorithmic selling. Price dropped quickly from $83 to $74 with very little pause. The entire move happened in about 30 minutes. While the drop looked extreme, it was a reaction to how fast silver had moved higher in a short period of time. Now let me show you what triggered this, because understanding the catalyst is everything. December 27th. 2 days before the crash, Elon Musk sends out a tweet that should have been a massive warning signal. 3 words. This is not good. What was he responding to? China had just announced new export restrictions on silver, effective January the 1st, 2026. Here's what's actually happening. China controls 60 to 70% of global silver supply. They're the dominant player. And starting January 1st, any company that wants to export silver from China needs a government license. The requirements for this license? You need to produce at least 80 tons of silver annually. You need a $30 million credit line, and you need government approval. What this does is eliminate every small and mid-sized exporter from the market. Only large state-approved companies can export now. And China just weaponized silver the same way they did with rare earth metals. And Elon's right to be concerned. Silver isn't optional for manufacturing. Tesla uses 25 to 50 grams per vehicle. Solar panels now represent the single largest source of silver demand, up 64% last year. Electronics, semiconductors, medical equipment, all of it requires silver. There are no substitutes for most applications. Now here's where it gets serious. Look at the actual supply and demand numbers. 2025 global silver demand, 1.24 billion ounces. Total supply from mining and recycling, 1.01 billion ounces. That's a deficit of over 200 million ounces. This isn't new. We've been running deficits for 5 consecutive years. The world is consuming more silver than it's producing. So where's that missing 200 million ounces coming from? Stockpiles, vaults, existing inventories. And those inventories are being drained at an alarming rate. COMEX silver stockpiles in the United States are down 70% since 2020. London vaults have lost 40% of their holdings. Shanghai inventories are at decade lows. We're literally depleting every major silver vault in the world. And now China is about to restrict exports of 60-70% of global supply. So let me ask you this. If China's restricting exports, if we have a massive supply shortage, if inventories are being drained, why did silver just crash 12% in 30 minutes? That's the question. And the answer reveals everything. This is what's known as a liquidity trap. And once you understand how this works, you'll start seeing it everywhere in financial markets. Think about this from the perspective of a large institution. You want to accumulate a significant silver position. But if you simply start buying in size, you'll drive the price up against yourself. you'll end up paying much more than you wanted. So instead, you engineer a scenario where you can buy at lower prices. Here's the playbook. Phase 1. Let the price run. In fact, help it run. You want retail traders excited. You want fear of missing out. You need everyone talking about silver going to $100, $150, maybe higher. That's exactly what happened in those 2 days before the crash, a 12% gain that got everyone's attention. Phase 2. Identify where retail is positioned. Large institutions can see order flow. They know where stop losses are clustered. Retail traders are predictable. They place stops at round numbers like 79, 77, 75 or 73. Phase 3. Execute the flush. Dump large sell orders rapidly. The price starts falling, hits $78. Stop losses trigger. Those forced sales push the price lower. Hits $75. More stops trigger. More forced selling. It cascades. Each wave of selling triggers the next wave. But here's the critical part. You don't want the price to collapse entirely. You want it to fall just enough to trigger those stops. Just enough to shake out weak hands. Just enough to create fear. Then you accumulate at prices that were impossible to get at $83. While retail traders are panic selling at $74, institutions are buying. That's the game. This pattern repeats in every major bull market. Gold did this multiple times on its way to all-time highs. Bitcoin crashes 20-30% during bull runs. It's how markets separate conviction from emotion. And despite how violent Monday's move was, the larger structure remains intact. Which brings me to the most important level you need to watch right now, 79.30. This is the crucial price. This number determines whether the bullish structure holds or breaks if silver reclaims and holds above 79.30, especially by the weekly close on January 2nd, the first trading day of 2026, then Monday's crash was just a shakeout. The uptrend remains intact. If silver fails to reclaim 79.30 and closes below it going into January, we could see a short-term bearish phase, possibly for some weeks, maybe the entire month of January. But even if January turns bearish, that doesn't invalidate the bull case. Major bull markets don't move in straight lines. They consolidate, they correct, they shake out participants who aren't committed to the larger thesis. Silver in 2011 crashed 35% during its run to $47. That was part of the bull market, not the end of it. Gold in 2020 had multiple significant corrections. Bitcoin has dropped 30% numerous times during its strongest bull runs. The move to $83 was dramatic, but it wasn't climactic. There was no widespread mania. Retail participation is still relatively low. We haven't seen the euphoric blow off top that typically marks major peaks. Now let me address the key question. Can silver reach $100 or significantly higher? Based on the structural factors I've analyzed, yes. Potentially $100, $150 or more. But the path won't be linear. There will be volatility. There will be days similar to Monday. Here's the supporting evidence. The technical breakout is substantial. Silver consolidated between $18 and $30 for years, a massive accumulation base. The breakout was explosive, not gradual. Multi-year consolidation breakouts typically maintain their trajectory unless fundamental factors change dramatically. The fundamental catalyst is strengthening. China's export restrictions begin January 1st. The impact hasn't materialized yet. When supply constraints actually hit global markets, price adjustments will follow. Industrial demand continues growing. Solar panel production requires silver. Demand increased 64% last year. Electric vehicles require silver. AI infrastructure and data centers require silver. Semiconductor manufacturing requires silver. Industrial consumption doesn't decrease with price increases. The material is necessary. A significant market structure issue exists. Physical silver in Shanghai trades above $80 per ounce. COMEX futures trade in the low 70s. This premium signals tight physical supply. The paper to physical ratio stands at 356 to 1, meaning 356 paper claims exist per physical ounce. If even a small percentage of paper holders demand physical delivery, the system faces structural pressure. We haven't seen euphoric price action. Real market peaks feature widespread participation, constant media attention, and retail mania. The move to $83 was strong but not manic. Most investors don't own silver. Most people aren't aware it reached all-time highs. When genuine euphoria arrives, it will be obvious. Real tops feel entirely different from Monday's panic. So what's the practical approach here? I need to be clear. I'm not providing financial advice, but I can share the framework I'm using to analyze this situation. I'm monitoring 79.30 closely. If silver reclaims and maintains this level, that signals bullish continuation. If it fails to reclaim it, that's a warning of potential short-term weakness. I'm watching the January 2nd close, the first trading day of 2026. Where silver closes that day relative to 79.30 will provide important information about near-term structure. China's restrictions are imminent. Supply remains deficit. Demand continues growing. These are facts, not speculation. But I'm also not assuming a straight path to $150. Markets rarely move linearly. When markets panic, institutional money typically accumulates. When markets become euphoric, institutional money typically distributes. Here's the bottom line. And then I'll let you go. What happened Monday wasn't weakness, it was a shakeout. It was designed to scare retail traders into selling so institutions could buy cheaper. That's the game. That's how it's always been played. And remember, the biggest opportunities in markets usually come disguised as disasters. Monday looked like a disaster. It felt like a disaster. But it might have been the opportunity of the year. Time will tell. But I know one thing for sure. The people who panic sold at $74 are going to be really mad at themselves if silver's at $120 to $130 in a few months. Don't be that person. Alright, that's all I got. If this video helped you understand what's really going on with silver, hit that like button. Subscribe if you want more content like this. And drop a comment below. Tell me what you think. Are you buying this dip? Are you staying in cash? Let's talk. And hey, look, whether you make money or not, at least now you understand the game. You understand how liquidity traps work. You understand that Monday wasn't random, it was engineered. And that knowledge, that's valuable. That's something you can use in every market you trade. Stay smart, stay disciplined, and don't let the market play you. See you in the next one.